If you're a complete beginner and want to get into investing, you need to know these 3 tips on investing so that you can go from this to this. And I'm Erika Kullberg, I'm a lawyer, and on this channel I talk about personal finance. And this video we're going to talk about the 3 things you have to know about investing, and they are all inspired by Warren Buffett, who is considered one of the most successful investors in the world. So let's dive in. Tip number 1. Pay off your debt first before diving into investing. As exciting as investing might seem, if you have debt, you might want to actually take a step back and pay off that debt first. Now, I'm not talking about all debt. I'm talking about what I consider bad debt. Things like credit card debt, where that debt isn't helping you to build wealth or increase your income. So if you have credit card debt, which the average credit card interest rate in the US is over 14%, you are almost always going to be better off putting your money towards paying off that debt rather than trying to take that money to invest in the stock market. The reason is, when you're paying off debt, every single dollar you put towards that, it's essentially like you're getting an immediate return on your money because you don't have to pay the interest anymore. With investing, it's not an immediate return, it's not guaranteed, and there is risk. The average stock market return since 1926 is about 10%, so accounting for 2% inflation each year, you're hoping for 8% growth year over year. You're almost always going to be better to tackle that high interest debt and get this essentially guaranteed return than risk that same money to get an average of 8% growth. And the only slight exception to this is if your employer offers a match, like a 401k match, you might actually want to go ahead and contribute to that minimum to get the match so that you're not leaving money on the table. But other than that, focus on getting that high interest debt paid off first. Here's how Warren Buffett explains it. In his 2017 Berkshire Hathaway shareholder letter, he shows this table. And he says, "This table offers the strongest argument I can muster against ever using borrowed money to own stocks. There is simply no telling how far stocks can fall in a short period." You can see this visual too. From around here to this point in 2000, the price of one share in Berkshire Hathaway went down 48.9%. Right here with the Great Recession, it went down over 50%. The reason why it's important to pay off your high interest debt first is that you don't have it weighing on your shoulders and you can make rational investing decisions. If you know that you have this debt, when you start to see these drops like this, you're going to panic and probably make irrational decisions and maybe sell at this bottom point here. Warren Buffett says in his letter, "Even if your borrowings are small and your positions aren't immediately threatened by the plunging market, your mind may well become rattled by scary headlines and breathless commentary, and an unsettled mind will not make good decisions." And he also says that no one can predict when these declines will happen. He says, quote, "In the next 53 years, our shares and others will experience declines resembling those in the table. No one can tell you when these will happen. The light can at any time go from green to red without pausing at yellow." But if you don't have debt to worry about, you're more likely to just ride it out and be rational and say to yourself, okay, this is a temporary setback in the market, but I trust that over the course of the next 5, 10, 20, 30 years, it will go up. And that's the benefit of paying off your bad debt first before you dive straight into investing. Tip number 2, delay gratification now for greater rewards in the future. Here's the thing. The world we live in teaches us that buying things now will make us happy. Instant gratification. You hand over your credit card now and immediately get something you want in return. Maybe we do it to reward ourselves or because marketing tactics have trained us to think that we need these things, or maybe we just want to fit in, maybe buy that nice purse so people will think more highly of us. Basically, we've been conditioned to think that materialism, buying nice things, is a way of showing our status, and we are constantly trying to elevate that perceived status. That's the keeping up with the Joneses mentality. That's why we don't want to have the smallest house in the neighborhood or the oldest car out of our friends, even though those are the financially savvy things to do. So how does that relate to investing? Well, if your paycheck is going towards spending things now and getting that immediate gratification, you're not going to have that extra money to put towards investing and building this future of wealth for yourself. In his 2017 letter, Warren Buffett said, investing is an activity in which consumption today is foregone in an attempt to allow greater consumption at a later date. If you can figure out how to save $150 a month and put that into the market with an average return of 8%, then after 48 years, that $150 a month will be worth just over $1 million. That means if you start when you're 18, then when you're retiring at 66, you'll be a millionaire. That's the power of delaying gratification today so that you can live a more free life in the future. That's also the power of compound interest, which Albert Einstein calls the eighth wonder of the world. You can watch this video to see how that works. That's also why, even though Warren Buffett bought his first stock at age 11, he's earned 99% of his wealth since his 50th birthday. He's the world's 7th wealthiest person thanks to this magic of compound interest. Tip number 3, returns decrease as motion increases. That's from Buffett's 2005 letter, and it's a really important thing for beginning investors to understand, so let's walk through it. A lot of people in the financial sector are going to encourage activity. They want you to be very active in investing because that's how they make money. Whether it's apps you're using like Robinhood and Webull, to hedge funds, to brokers, to people selling courses about day trading. All of these players are counting on you to buy and sell frequently because that's how they make money. The problem is, that's how you end up losing money. Returns decrease as motion increases. The more moves you're making in investing, the more you're trying to buy and sell, maybe attempt to time the market, which isn't possible. On average, your returns decrease. There are tons of studies out there that show you that in most cases, thinking that you can outperform the market by doing things like buying and selling constantly will result in smaller gains. In his 1990 letter, Buffett said, "Lethargy bordering on sloth remains the cornerstone of our investment style. This year, we neither bought nor sold a share of 5 of our 6 major holdings." Okay, so if you're not buying and selling constantly, what is the investment strategy? Well, according to Warren Buffett, it's to put your money into a very low-cost S&P 500 index fund and just let it sit there and watch it grow and become a millionaire. And next, I'm going to see you in this video where we go into detail about why he thinks that this is the best investment strategy. See you there.